Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert Dan Eisenstadt. Now, Dan is the founder and CEO of TerraVet Real Estate Solutions, an investment firm focused on veterinary and healthcare related assets. Now, for more than a decade, TerraVet has partnered with veterinary practice owners to maximize the value of their real estate. And whether they're selling, leasing, or expanding, Daniel and his team provide the necessary knowledge and resources to reach the healthiest outcomes for their clients. So, guys, without further ado, I'd like to welcome Dan Eisenstadt to the show. Dan, how you doing today?
I'm well. Thanks for having me. I appreciate
Yeah,
it.
excited to have you here. Excited to learn more about your business, peel back the curtains a little bit, and better understand what it is you do. And so, I guess Dan, let's start here. Let's back it up a little bit. For those that aren't familiar with you, don't know who you are, don't know what you do, or what your background consisted
Sure.
of. So let's go back a number of years. Tell us more about yourself and how you found your way into this industry.
Yeah, no, happy to do it. Thanks. So I always joke that I'm a recovering lawyer. You never fully recover. And I practiced for a short period of time, then did some entrepreneurial stuff in Poland, and then went back to business school. Coming out of B school, I joined a sort of a multifamily office, real estate and private equity shop in Philadelphia. And right around 2009, as the Great Recession was coming, a couple of guys and I decided to co-found a roll-up of animal hospitals, not of the real estate, of the operating practices. And we had a lot of intuition. We're all dog guys. And we also had a lot of intuition that veterinary was a pretty solid business with a lot of good tailwinds, good demographics. But also, we thought that there were a lot of veterinarians where we could help drive better business performance than maybe the veterinarians themselves. So I ran that as president for the first 5 years. It's called Community Veterinary Partners. We ultimately sold to private equity, and then now OMERS, Ontario's municipal pension fund, owns the business, and it's doing north of $500 million of revenue and has about 150 locations. So that was our entree into the veterinary sector. About 3 years into that, I got a call from one of the veterinarians whose practices we'd actually purchased or partnered on. And basically she said she and her husband wanted to sell the building because their kid was going to college and they were ready for another liquidity event. And we started talking and we ended up negotiating for us to purchase the building. And I had a little bit of a light bulb went off because at that point, there were probably 7 or 8 corporate groups that were consolidating the OpCos, the operating veterinary practices, but no one was on the PropCo side at this point. And most of the real estate was owned by veterinarians. And my light bulb was thinking, boy, if this conversation was happening between me and this veterinarian, and I know there are 7 other groups and growing that are working to buy the operating business, but no one's buying the real estate, maybe there's more opportunity here. And so we were really probably the first PropCo acquirer of veterinary real estate in an institutional capacity. What ended up happening was that the 7 or 8 corporate groups that were doing the OpCos grew. It's now over 60 groups, with the largest group being Mars. The candy company owns some of the largest veterinary brands, VCA, Blue Pearl, Banfield. And so as that was happening, what happened was those folks that were trying to buy a practice often needed someone to come in and buy the real estate. We can talk a little bit more about what those dynamics are, but that's really how it started. We've grown a decent amount. So we now have a couple of hundred buildings in 40 plus states, some version of about $500 million of real estate that we manage across a fund and a private REIT. So the light bulb ended up being good, and it ended up being a good sector. I think for a lot of different reasons we can get into, it's a pretty interesting and differentiated sector. So anyway, that's the backstory.
I love those ideas. That's one of those ideas that you probably lost sleep for a number of weeks. Like you just couldn't stop thinking about it. When that light bulb finally went off. I'm guessing, right? And
yeah, you're right. You're right. It did. Although it was interesting because the very, as you know, with a lot of new ideas, the first 5 or 6 people you talk to about it that don't know, they give you the really what that real estate. What is that, right? And of course, what I knew at the time, this is sort of part of it, is at the time and still today, a lot of veterinary real estate is like converted houses with the old 70s rug. And, it's not institutional. But I also knew, having been around it, that there were quite a few purpose-built buildings on the corner of Main and Main that were freestanding, decent 7,000 foot buildings that were quite institutional. And I also kind of had the sense that the trend was moving away from the converted houses and more towards institutionally built Main and Main, top 100 MSA kind of real estate. And so that was part of what gave me conviction, as I got a couple of eye rolls. Like, I've never heard of veterinary real estate. So
I love it. I love it. So back again, just before we move forward, I want to get a better foundation laid here. So Community Veterinary Partners, 2009 is when you guys founded it. Saw an opportunity there. Obviously, you guys, you had a researched a number of different data points that suggested that the macroeconomic tailwinds were really
yeah,
pushing that space forward. What I guess I'm sure there was maybe other things you've looked at as well, other industries that you
sure.
guys were kind of considering or exploring. I guess what were some of the data points that really
Yeah.
made the veterinary space rise to the top?
Yeah, there are a couple of things. First, it's unusual in that it is healthcare, but where the practice owner controls the pricing lever. And what's so unusual about that is that in most healthcare, reimbursement, right, insurance drives what can be charged. In veterinary, because it's all private pay, and there is no reimbursement, it is pretty attractive from a business point of view. Now, obviously, what's happened in the last 10 plus years is rates, charges have gone up a lot. In fact, it's in the news a lot. Some of that is because of the institutional investors. Some of that is evolution and innovation in veterinary medicine. But we thought, boy, not having to track down and collect from insurance is a pretty exciting thing in healthcare. I'd say a second thing is that the trends around pet ownership and treating our pets like our kids were pretty obvious back then and have only accelerated. Now, I think, I can wax on for a while. We won't do that about this, but part of this has to do with the demographics of who pet owners are. When I was a kid, pet owners were more, families with kids. Today, what you see a lot of in terms of growth in pet owning demographics are senior citizens, empty nesters who want to replace a kid, go get a dog. Difference there is they have a lot of disposable income, right, relative to that, young family. The other thing is people getting married later or having kids later. So you'll see, men and women in the city with a dog or a cat before they get married, or you'll see, folks that get married but want to wait years before they have kids and they'll get a dog, right? In all cases, they're examples of dogs as children, cats as children, and that drives some spending, right? And that means that, and also drives some demand for kind of a different type of facility that you could be in. So, sort of thinking about real estate, back in the day, maybe converted houses were okay, but the more we're thinking about our pets as our kids, the more we're going to demand a different type of environment that we go into as pet owners. And also the more that veterinarians are going to demand a more healthcare oriented space to be in, right? So I think
Yeah.
those are some of the trends.
Yeah, it's funny. You just help me repaint the picture of what growing up when I was a kid. We always had dogs in the house, and I remember the vet. My parents still go. It's gone through different generations, but still the same location, and it's an old converted house,
There you
very
go.
old converted house.
There you go. Right. So
Yeah,
that's and I think part of what we've also seen, it's interesting in veterinary, there's a major labor shortage, like there is in a lot of sectors in the US. But in veterinary, because there are a limited number of veterinary schools and we're not producing enough veterinarians for the demand, part of the other underlying thesis here is that veterinarians are going to want to work more in purpose-built buildings that are more medical in nature. And so the better buildings are going to enable our tenants to recruit and retain their veterinary talent, healthcare talent. That helps too.
yeah. So you'd mentioned that, I guess that when the light bulb moment went off, it was one of the prior veterinary clinics that ultimately sold into Community Veterinary Partners. Obviously, they've
Yes.
retained the real estate, and they were looking for this additional liquidity event or new liquidity event by selling the real estate piece of it. Yeah, that's on an individual basis. I'm assuming at this point in time, TerraVet, most of your deal flow probably comes from PE groups. Is that a good assumption, or are you still doing a
About
lot of
it's a
one-offs?
great question. We do an enormous amount of one-offs, but you're right that a lot of the private equity-backed corporate groups are the source of it. So the way this usually plays out is the following: business development person for a corporate veterinary group is looking to acquire a practice and has been talking to a veterinarian for a while. But in many of those cases, the veterinarian who owns the real estate says to that biz dev person, "Hey, listen, I'll sell you my practice, but I want to sell everything. If I'm selling my practice, I want to sell my real estate at the same time." What we realized is that most of those corporate groups, not all, but most, don't want to buy the real estate because it's a different risk return. They don't want to tie up cash on their balance sheet. They have a higher return expectation. And also, many of their investors don't want to have an allocation to real estate in what is their private equity bucket, right? They want to divide up asset allocation. So if you're that biz dev person, you have a problem which you want to solve, which is you have a great practice you want to buy, but you need a real estate partner. Enter TerraVet. So we've positioned ourselves over many years as a real estate partner to those corporate groups. We get brought in by them when they have a practice under exclusivity. They'll bring us in to buy the real estate and close coterminous and put a new lease in place with the corporate group. So that's about half of our acquisitions to date have been that process. Now it's still a one-off, but it's a pretty nice one-off because the corporate group is teeing it up to us, right?
Yep.
So that's one. The second place is about 40% of our deal flow comes is for those corporate groups when they buy a practice where the veterinarian owns the real estate and says, you know what, I want to keep the real estate because my accountant said it's good passive cash flow, right? Why don't I want to keep the real estate? We have a small biz dev team that tracks every sale of a practice to a corporate group because what we've learned is 3 or 4 years later, 5 years later, the veterinarian retires and they move to, I don't know, Tampa or Boca or Phoenix. And when they do, they think, maybe I think I want to sell my real estate. And so we've been tracking them. And often we're buying. Now, often when we buy then, the veterinarian hasn't done a great job of negotiating his or her lease with the corporate group. So for example, it may not really be triple net. There may not be a lot of term left. Their lease may have bad assignment provisions. There's a variety of things, but we know the C-suite of the corporate group. So we can agree to buy the building knowing that we can go back and do a lease amendment at closing. And so, and in a lot of cases, we're competing in those situations with brokers who are trying to get a listing and trying to find a 1031 tax exchange buyer. And we're a buyer. And so we say, listen, we can close in 60 days. You may do better by listing it, but we're an actual buyer. And, so that's another 40% of our deal flow. And then the remainder is the isolated examples where some brokers may have some interesting real estate where we think we can fix something on the lease or renovate something and make it more accretive. That's about 10% of our transaction flow.
And the revised lease terms are like the ideal lease terms that you want to see. What do they look like? Not necessarily rates per se. Is it full triple net?
No. It's a great question. So we look for 10-year leases or greater in terms of term. We want absolute triple net, but I can live with modified triple net. What I mean by that is in absolute triple net, zero responsibilities, like not the roof, not the structure, not taxes, right? Not insurance. But we sometimes will take on roof replacement and structure, and we'll keep a reserve in place. But I don't want to have HVACs or have to redo parking lots. That's not it. We're also, we like financial reporting. So I want to know how the four walls are doing, and I want to be able to let our lenders know, and if we have to sell, I want to know that. That's one that a lot of folks don't look for. And then I guess the last large bucket, there's other things, but is I love to get a corporate guarantee. So in many respects, this is, VCA, which is a subsidiary of Mars. If they're buying a practice, then I want not just the practice on the hook, I want VCA on the hook. And a lot of the not VCA, but a lot of the private equity-backed corporate groups will create special purpose entities to buy the practice. And if you only have the special purpose entity as your tenant, you don't have much, right?
That's right.
If on the other hand, I have, KKR's portfolio company, as my guarantor of the lease, that's pretty good.
Are
So
they
those
are,
are some of the
yeah.
things we want.
Are they typically amenable to those corporate guarantees?
They are. The way I think about it is, this is a very steady business, veterinary, just like healthcare is generally. And as long as it's a really good building, the top 25%, so it's top quartile building in a top 100 MS, metro area with good practice culture and 8 or 9 doctors, the corporate group is sitting there going, well, we're never leaving, right? So
Right.
I'm happy now. What they want something for the corporate guarantee usually. So we usually have to trade tenant improvement dollars
Mhm.
or reduce the rent a little, lower the escalator. And that's, I think, a bit of sort of the art of doing this, is how much you have to give up to get that insurance. Because in many respects, if they're never going to move the practice or leave, they're just getting free something in exchange for an option, right? For their guarantee, which isn't going to cost them anything. So that they are usually amenable. Now, if it's a small building and a kind of a crummy building in the middle of nowhere, it's pretty hard to get. So it really is real estate dependent and practice dependent.
Yeah, so let's talk about that. Market selection. I mean, I
Yeah.
guess maybe some data points around, what would be a good opportunity, a good fit for your team, assuming the right price, you can negotiate the
Yep.
right lead terms, or one that would just you guys would pass on for XYZ reason. What does that look like?
Yeah. Look, I think I mentioned earlier that labor is the biggest issue in the veterinary sector. Isn't going to be demand, right? There's a lot of demand. There's more pets, and there's more folks that want to take their pet into the veterinarian. The challenge is you need to be able to staff practice, and it's really hard to do. So our biggest issue is we don't want to buy where it's unlikely that you're going to be able to recruit a veterinarian, right? So Tampa, no problem, right? Raleigh, Durham, no problem. The Upper Peninsula of Michigan, more challenging, right?
Sure.
We don't own any. We own in Michigan, but in the greater Detroit suburbs, but we don't own a single building in Alaska because it's really. So the first issue is going to be, where you can recruit and retain doctors. I think a secondary thing is we don't own a lot of urban real estate. It's just complicated in urban areas. So most of what we own are suburban,
Mhm.
and we're looking for the top. I'll go to 150, 200 metro areas demographically, some with a little bit of scale. We'll also go to SEC cities, big college football towns. We can make that work. Those are really, and then from a location point of view, we invest in 2 different types of veterinary buildings. One are mega general practice buildings, which are typically 6,000 to 10,000 square foot buildings, freestanding, usually on a main or secondary road with parking, good traffic counts, and usually within a couple of miles of pretty significant residential areas, because it's a local business. You don't want to drive 45 minutes to your general practice veterinarian. The interesting, unique thing there is even those general practice buildings have a fair amount of build out, because they're surgery suites in every veterinary practice, removal of foreign objects, spays. So there's a decent amount of build out for a small building that makes it a place that you don't really want to move from, because you're talking about hundreds of thousands, maybe north of $1 million of build out on a few $1 million building. The second type of real estate that we buy are specialty emergency 24/7
Mhm.
veterinary hospitals. These are usually not in sort of retail suburban areas. These are really they're in suburban, but they're in flex industrial or even commercial
Yeah.
locations, because they're destinations, right? And they're typically 15,000 to 50,000 square feet with even more build out. These often have MRIs and
Wow.
CTs or linear accelerators. These comp to ambulatory surgery centers or little hospitals. And so those buildings are, they're a little bit of a different animal, pun intended, I guess. But we like both of them, and it's interesting because in many respects, in our REIT, investors will get a little bit of interesting exposure to kind of what is more flex industrial, commercial sort of office and retail, but all under kind of veterinary or niche healthcare, right? Because we're more thinking about it in terms of how the tenant's using it and about the stickiness of that real estate than being as fixated on, is it retail or is it office.
Mhm. 50,000 square feet. I mean, that is massive in size. Obviously,
It's massive.
there's a case example that you obviously have either looked
Yeah,
at or you
sure.
currently own. That's 50,000 square feet. Just curious.
No, I'll give you, it's a great example. So we own a property in the northwest quadrant of Denver. So just north of the Vail Pass, in Wheat Ridge, Colorado, on the way to Arvada. And this is it is a almost 50,000 foot, 47,000 foot hospital. It was, the veterinarians took a building that was like I think it was an engineering office, and it was originally 25,000 feet, and they built it out. And it is state of the art. We bought it probably 5-6 years ago, built 7-8 years ago. It's got MRI, CT. It actually has a feline blood bank. It has an orthotics lab. It has an underwater treadmill for rehab for dogs. I mean, it's a pretty amazing property. And at the time we got it, it was leased to National Veterinary Associates. Actually, it was leased to a group called Ethos, which is now part of National Veterinary Associates. But interestingly, as part of a sale of Ethos to National Veterinary Associates, the Federal Trade Commission, worrying about antitrust, made them spin this out to a different buyer. So now it's owned by a different corporate group called Veritas. But we have I think we probably have 16 years left on the lease there, triple net. So that's a great asset.
Yeah, no, very, very interesting. So curious as to the real estate itself, assuming the right market, you can get a corporate guarantee from a strong guarantor. Um, how but maybe the building itself isn't as desirable for XYZ reasons. Maybe just functionally obsolescent, or might be in the next decade or two, or
Yep.
just how much of consideration comes into play there with just the real estate itself, assuming again the more so the building itself, not the real estate, because the real estate,
Yeah.
good location, good market, good corporate guarantee in the lease. Would you
Yeah.
still pass if the building itself wasn't up to par?
Usually it's a dialogue with that corporate operator, right? Because often, if every one of the things you mentioned, Kevin, works, right, then that corporate operator says, boy, we would love to not have to move, right?
Okay,
We've got
that
7
makes sense.
doctors. We're soon to be obsolete facility.
Hmm.
But boy, if we could go ahead and renovate fully or do an add-on and then a scrape, right? And we have a good example of this now. It's actually it's an interesting story. We have 2 veterinarians, husband-wife team in New Jersey, that bought an old 4,000 foot practice from an older veterinarian who was retiring. At the time, it was pretty small, in terms of sort of the number of doctors and their practice. They bought it. They came to us and said, boy, would you guys try and buy the building from the doctor's retired? He's now in Florida. And we said, sure. We bought it. We entered into a lease with them. They've since grown it. They now have 7 doctors there, from 1 to 7, right? And they then came to us and said, we're bursting at the seams. And thankfully, we're on a square acre off a main road in New Jersey. So literally, we are right now, we're about 70% on building a new 10,000 foot building for them on the same site. And once that building's done, they're going to move in. We'll demolish the old building and turn that into parking. So they really won't miss a day of being open, and they're watching it go up right next door. So that's happening in a variety of places too.
That makes sense. So you got TerraVet. You're currently on. I believe is it maybe it's the same fund, original fund. You've just expanded it, but you got a fund open and operating. Just curious as to the performance, if you can speak to.
Yeah, sure. So we've actually had a fund business. We have a current fund 3, which is closed and about 90% invested. And then we have a REIT, TerraVet REIT. Mm-hmm. TerraVet REIT is an evergreen vehicle that, and we formed that about 2 years ago. We formed that so that we could allow veterinarians and doctors to do UPREIT transactions, to basically, contribute a building in exchange for ownership in the REIT. And so the REIT is what's open. So just to give you a sense, the REIT has about 65 buildings in it, and probably about 250 million of value, of acquired value. And then we have Fund 3, which has another, significant amount of value and many more buildings, probably somewhere about 150 buildings. Just to give you a sense of performance, we're, our target is generating about a 6% plus cash yield. Very tax efficient because there's a lot of depreciation shield that in the REIT we can pass on. So we like to say our 6%, 6 to 7 looks more like 8.5 to 9 if you were taxed on it. And we delivered our fund two, just to give you a sense. We got a little bit clipped in terms of interest rates rising so quickly. Yeah. But notwithstanding that, we were able to generate about 1.45 MOIC and about an 11% cash return, even in a situation where the Fed was raising rates and we got a little squeezed. So, our target overall return for the REIT, longer term, we think we're one of the early ones building this kind of portfolio. And when rates someday come down, I don't know when, there'll be folks that will be chasing growth and looking for niche sectors, and we're building an institutional portfolio. So if we can ultimately exit to a Blackstone REIT or a Blue Owl or one of these enormous net lease, not just net lease, but real estate aggregators, if we can exit at a little bit lower cap rate than what we entered at, and get some cap rate compression, when we model it, we basically are looking at 6 to 7% cash flow along the way, and then if we can exit at 100 basis points compression on cap rate, then we think it's a 2x multiple and a 20% IRR. So that's kind of what we're playing for. And the way we think about it is we've had 100% rent collection since I started doing this. We've had zero vacancy, no issues. Now we actively manage it. So we will sell some buildings every year into the 1031 market to kind of trim the fat on the portfolio. But we think it's a less correlated, relatively recession resistant, pretty good on inflation because we're passing on, it's triple net, and we're getting annual rent bumps, right? So we think it's a pretty downside protected 6 to 7%, but unlike a bond, it actually has equity upside because we actually own the real estate. And if we're right that we're the early movers and that others will want this type of portfolio, then there's really a nice equity return for everyone at the end.
Yeah, no, that's beautiful. I love the idea as well, the evergreen fund that you guys have structured. Just curious, given the opportunity now that sellers can basically move their asset or move their shares of their asset into the REIT. I guess I'm assuming that's via 721 exchange.
721, yep.
Yeah, I get curious as to how many opt for that, that fully understand the benefit of it and actually raise their hand and say, I love that idea. Allowed me to just get away from the responsibility of this, let you guys do your thing and not get hit with taxes, get continued cash flow and distributions that I can go to Boca, go to Tampa, retire.
Wherever it is, right? It's a great question. I'll tell you what we learned where it's really been incredibly effective. A lot of these larger specialty emergency buildings, those 30, 40, 50,000 foot buildings, were often built by entrepreneurial veterinarians who, were partners in a practice, 3, 4 veterinarians together, maybe 5, right? They get together, get a loan, do the financing, build that building, right? And in the situation where those end up selling the practice and then they hold on to the real estate, invariably what happens is that the 4 or 5 that were once partners in the practice are no longer. They're just partners in that real estate. And a few years later, 1 or 2 want to move to Tampa. Someone gets sick, unfortunately. Someone doesn't like someone else, right? And now you've got a whole group of former partners that own a really substantial piece of real estate together. And they're in a little bit of a quandary because someone says, I want to sell my piece. I just want more cash, right? And another partner says, no, I don't want to get hit with taxes just because you want liquidity, right? And so what's really elegant about the Section 721 UPREIT is we can say to this group of 5, hey, listen, we value your building at $20 million, but why don't you guys tell us how much cash do you want? You want 10 million in cash? You want 10 million in REIT units and REIT equity? Perfect. You guys then, the guys that want cash can take the cash. The guys that want the equity can take the equity. You guys figure out your tax piece on your own, and it's a pretty nice solution for those former partners. So it's been, we've done probably 20 transactions that are UPREITs. In certain cases, multiple buildings. Maybe it's 25 by now. But I'd say the super majority have more than a single owner of the property, and it's some dynamic like what I just described.
Got it. Got it. No, that's interesting. I appreciate you sharing that feedback. I was just curious. It's not, it's simple in nature in theory, but
Yeah.
I've found that a lot of tax advisors, our fund allows folks to essentially 721 into our fund, and it's become very difficult to explain to like a mom and pop type owner, it's
The benefits.
basic, but yet there's complexities and what those benefits, and a lot of times their tax advisors have never even heard of the 720
I never
exchange,
heard.
they interpret it in their own manner when they go read the code, and it's just we've
It,
found that to be challenging. We've found
you
success in
are,
it, but not on a
yeah,
large scale.
you are right. So I think the dynamic where it's worked for us is what I described, where there is some driver where someone wants cash and someone doesn't, right? And
Yep.
that's where it really
Yep.
works. The other thing that I think is true is the sales cycle is long. So there's no 90 days on these. These are, 6 to 9 months, because everyone needs to get comfortable. And then the other thing I'll say is that we have our entire REIT portfolio valued quarterly by an investment bank, by Stout. And they go in and they do a full appraisal. I mean, it's really a full valuation, and we adjust the share price based on their valuation. We have a board that reviews that valuation, then adjusts the share price. Because one of the questions that people often get to on the 720 is, well, wait a second, how do I know that what I'm getting in value is a reasonable value? And so, our answer is, here's a 460-page updated report from a very reputable real estate group that, by the way, over the last year and a half has been marking down our value, because as interest rates went up, right, and cap rates increased, our value of our REIT, the stock came down. So I think that's fair and square. That's what it is. And so hopefully some of that transparency about that valuation has helped to deal with some of that. But you're right, it's complex, and we think it's really beneficial, but it takes some time to explain.
Sure. Well, that's fantastic. Well, Dan, I really appreciate you coming on the show. It's been a fun conversation here, learning about TerraVet and the business, and just really the how that light bulb moment came about, and you guys saw an opportunity, you executed on it, and it sounds like it's going quite well. So appreciate you coming on and sharing the story. For
Thank
those
you.
that are tuning in that want to learn more, they have an interest in your investment offerings, or just learning more about your group, where's the best place to find you?
Go to our website, TerraVetRealEstate.com, and happy to talk to anyone who's got interest.
And I said TerraVet, and I apologize there. So just want to make sure there's a correct. It's TerraVet, guys. It's so veterinary TerraVet. Yeah.
You got TerraVet realestate.com.
And we'll make sure we'll put that in the show notes as well. And with that, Dan, I appreciate you coming to the show. It's been a pleasure having you, and appreciate you sharing your story with us.
Thanks, Kevin. Appreciate it.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.